why.
Yes, sir.
Right, so let's see. Let's start over again. You can see my screen?
Yes, sir. Yes, sir.
Okay, so
Yes, sir.
I don't know kuti mama pedzera kunzwa papi, but I will just start from the introduction. We are saying we've got a set of financial statements. We've got a profit and loss, and we've got a financial position of our company. We want to analyze our performance. When you're analyzing performance, yeah, kana muri kundinzwa muchiona chimuta, you can see
screen is connected.
Can anyone see it?
Screen is connected. Maybe it's my phone's problem, but just connect.
Nyangwe kuno kupango buda kaji family.
Yes, screen C. Yeah, right.
Yeah, that's right. Thank you.
Okay.
Right, see.
All right, so let's
Now it's about.
Yeah, Gonika.
Saka chimuta iti tange basa. Right, so ndanga ndichiti tinenge tapiwa a set of financial statements. Ine ma financial statements atataura nezvawo profit and loss and other comprehensive income, statement of financial position, and the other statements that we are not going to be talking about. Then we want to determine whether we performed better or if we are in a better financial position than before. So that means we are always comparing it with something. So we could be comparing our performance for 2022 against performance in 2021 or against performance in 5 years ago. We don't know that we're generating more profits than we were generating before. Are we in a better financial position than we were before? So we are comparing current year and a year ago or 2 years ago. Or we could be comparing our performance against performance of a competitor. For example, we could be comparing Econet Wireless against Net1 or FBC Bank against CBZ. We are comparing two companies within the same industry. We could be even comparing two companies in different industries to see the differences in their performance and which company is performing better. Or we could be comparing our performance against the budget we have set for ourselves. In terms of revenue, we are comparing our revenue for our actual revenue against the target we have given ourselves. So we are analyzing financials based on a certain benchmark to see our performance in relation to what we have set for ourselves. So we analyze my financial statements using my ratios, and there are broadly 4 groups of ratios that we can use. So there are profitability ratios that measure perhaps the relationship between the revenue that or income we've created and the expenses that we paid to generate that income, and then in relation to the assets that we actually used or the capital that we actually employed to be able to generate that profit. We also look at liquidity ratios that basically just measure the stability of the entity or the entity's ability to meet its short-term obligations as and when they fall due. Are able to pay mari dzedu dzatofanira kubhadhara zvikwereti zvedu zvese pazvinenge zvaakudipa. That's basically liquidity. Efficiency and position, we are not going to talk about them because they are beyond the scope of this module, but basically efficiency and position measure our ability to utilize our assets efficiently and our market position if we are a listed company. So for now, we are going to focus on profitability and liquidity. But maybe before we do that, we need to consider the audience. So why do we need to worry ourselves with the preparing financial statements and then analyzing them? So we analyze financial statements and we take perspectives of these groups of stakeholders. So for a potential investor, you would want to know whether you're actually investing in a company that is growing or not. So if you are to realize that a profit younger 10 million last year, this year 7 million, would be skeptical to invest in that company because you then see that the performance is actually going down instead of improving. So investors use ratios to determine whether they should actually invest in a company or not. Banks, before they give you a loan, would want to see your ability to actually pay my installments as and when they fall due. So they'll be interested in your liquidity. They'll also be interested in your profitability. Are you actually making profits that you can then use to pay them when they want you to repay their loans? Would you expect under normal circumstances that if you are looking for a job and you are considering whether to take an offer or not, you would also be interested in the financial health of the organization. Are they actually going to be able to pay my salaries as and when they fall due? Suppliers, especially those that give you goods on credit, would also want to know whether you actually then be able to give them their money as they fall due. They will be interested in your liquidity. They will be interested in your profit margins as well. Are you profitable enough to be able to continue to buy from them if they are going to enter into a long-term contract with you? So these are just examples of users of financial statements that would ordinarily use ratios to analyze performance of an organization. Right, so let's start with profitability. So these are the 4 basic ratios that we use to measure performance of an organization from a profitability perspective: your gross profit margin, your operating profit margin, your asset turnover, and your return on capital employed. So let's start with these 2. So your gross profit margin is basically the gross profit that you would have made divided by the revenue. You multiply that by 100%. So what this basically means, so let's say for argument's sake, you have sold an item for $100, but you had ordered this item at $60, which means the gross profit that you have made is $40. So we are saying you have made $40, which is your gross profit, and your revenue is $100. If you express it as a percentage, it means you've made a gross profit of 40%. So what it means is, for every dollar of revenue, what is actually coming to you is 40 cents. The other 60%, 60 cents is going to the person that actually gave you or sold to you the thing that you then ended up selling. So to then expect for you to have a good financial health as an entity, you should have a gross profit margin that is as high as possible. You may get scenarios that would ask you to interpret that particular ratio. So if we have a gross profit margin of 40%, how can we improve that gross profit margin? So if you want to improve the gross profit margin, you could improve it by negotiating better prices with your supplier. So if you negotiate better price with your suppliers, it means your cost of sales will go down, your gross profit will go up, and then ultimately your gross profit margin will go up. Or you could consider increasing your prices, because if revenue increases and the cost of sales remains the same, it means you are likely then going to make a higher gross profit margin. That's how you improve it. So if gross profit margin, for example, for 2021 was 40%, and for 2022, it was 50%. You could then say the 10% increase in gross profit margin could have been because we increased our prices and our revenue increased, or we negotiated better prices with our suppliers and then the gross profit increased. So it could then be the other way around. If it decreased, it means maybe you reduced your prices, or means the gross profit margin has gone down. The operating profit margin, we said operating profit is basically your gross profit minus your operating expenses and selling and administration expenses. So if your operating profit margin has improved, so we know that we get to operating profit after total value gross profit, which means whatever affects gross profit also affects operating profit. But over and above the selling price and the cost of sales we've already talked about, if your operating profit margin is improved, it means you have managed your costs better. So the lower the operating expenses, the higher the profit from operations, and then the higher the operating profit margin. So from a profitability perspective, except for return on capital employed that we are going to discuss, these are the most important ratios that you can use to assess the profitability of an entity. Right, so let's look at an example. We've got success company. This is a statement of profit and loss of other comprehensive income. Sakatakapiwa, all of those figures, we are required to calculate gross profit margin and operating profit margin. Right, so like I said, you'll be given 2 years. So I want to compare our profitability for 2021 and for 2022. So if we are calculating gross profit margin, this is what we will then do. Right, so we'll say gross profit margin is equal to gross profit over revenue. So it means for 2020, for 2022, we would say our gross profit is 100, sakatakuti 100 over 210, which is our sales. Then for 2021, we would say our gross profit is 44,000 over, sorry, my screen is obscured the value of sales. So let's say if it is 140. So we then express what we get there as a percentage, and we also express what we get there as a percentage as well. So if we say 100 over 210, let me just do a quick calculation. So 100 divided by 10, we will then get 48%. Then if you say 44 divided by 140, we get 31%. So what this means is, if we are comparing 2021 and 2020, we can see that our gross profit margin increased from 31% to 48%. So what this means is, we could have increased our prices that resulted in us getting a bigger margin in terms of the gross profit that we got. Hence, our gross profit margin has increased to 48%. Or we could have negotiated better with our suppliers, resulting in us paying less in terms of cost of goods sold and then getting more in terms of the gross profit. So this is what could then explain the reason why our gross profit margin increased from 31% to 48%. So that's basically as far as gross profit margin is concerned. Then we can also then use the same information to calculate our operating profit margin. Right, so our operating profit margin is basically our operating profit over our revenue. So we do the same. Say our operating profit, sorry, just a moment. So our operating profit is 31,500. So we say 31,500. Divided by 210. Right, then we express this as a percentage. 31,500 divided by 210. It gives us 15%. Right, so that's as far as 2022 is concerned. Then 2021, takuti 25,200. So 25,200 divided by 140,000. We get 18%. So we can see that our operating profit margin actually went down from 18% to 15%, despite the fact that the gross profit margin for 2022 was actually better than 2021. So to explain this, we could argue that our operating expenses were significantly higher in 2022 than 2021. That is the reason why our operating profit margin actually went down, even though the gross profit margin has actually gone up. So that's basically how we interpret or how we explain the reason why the gross profit margin increased by the operating profit margin actually went down. Now, you would also realize that your cost outline also requires you to calculate net profit margin. But net profit margin is a ratio that is not widely used in industry. The reason why this is the case is What we are interested in is operating profit, because that reflects our ability to manage our costs and to generate more revenue. The net profit margin is affected by income tax, which we cannot control, because the tax authorities are the ones that determine the taxes that they want to charge us. We can also not measure our performance based on the way that we finance the business, because finance cost is a reflection of how we are financing the business. Are we actually borrowing money or requesting money from shareholders? So the finance cost in itself is not reflective of our ability to generate revenue or to manage costs. But perhaps if the question then insists that you calculate net profit margin, the net profit that you then take for 2022 is the 26,500. You divide it by 210, and then the net profit for 2021 is the 200. You divide it by 140. So that's the net profit margin. Right. So those are the two basic ratios that we then use to determine profitability: your gross profit margin and your operating profit margin. So operating profit margin or operating profit rather is sometimes referred to as profit before interest and tax, or PBIT. I've already shown you the structure of the statement of profit or loss and other comprehensive income. So you would remember that this operating profit just before finance cost was actually the profit before interest, which is the finance cost and the income tax. Right, so let's move on to the next ratio, which is the net asset turnover. So net asset turnover basically mari yawaka-investa in the business waispina kangani, and kuspina kwaunta mari is basically the revenue that you create. So let's say, for argument's sake, you invest 10,000. Toto watenga kombi yako ne 10,000, and then over the year wawana 100,000 in terms of my take-ins. In terms of revenue over the year. If you divide it by the amount of money that you actually spend, in this instance, you'd realize that is 10 times. So it means waspina mari yako ka 10 based on the amount you invested in the revenue that you actually managed to generate from that investment over a specific period of time. You can express it as a percentage by multiplying by 100, or you can just leave it as it is and then you express it in terms of time. So in this case, waspina mari yako, or you have turned over your investment 10 times. So that's your net asset turnover. Right, then the last from a profitability perspective, which is probably the most important ratio you are going to come across in accounting, is your return on capital employed. So basically what we want to determine is, if I've invested money, how much am I getting in terms of actual return, not revenue, but actual profit that is coming to me after I've deducted all the expenses that I would have incurred to be able to generate that revenue. So we are then looking at the profit you would have made over the total amount of money you would have invested in the company, which is your capital employed. So if we look at it from this question's perspective, let's say we are considering this scenario. So in 2021, the return that we made, so our return is basically our operating profit, because remember, finance cost and income tax, we are sharing with the people who provided us with the finance and the tax authorities, but the amount that we actually generated from using the assets or from using the money that we invested is actually the operating profit. So we said our operating profit is 25,200 in 2021. So we are going to say our return on capital employed is 25,200. We had invested 130,000 in the company. So we want to determine the return per each dollar that we invested. In 2022, we made 31,500 before paying interest and tax, and we had invested 150,000. So we wanted to then determine the level of return compared to the investment we had actually made. All right, so from 2021, the return was 25,200, and we had invested 130,000, which means we made 19% in terms of return. Then 31,500 divided by 150 would have made 21%. So what this means is for every dollar that we invested in the business, we got a return or a profit of 19 cents. And then Panaba, for every dollar that we invested in the business, we got a return or a profit of 21%. So if this is 2021 and this is 2022, it means we actually utilized our funds better in 2022 than in 2021. This could have been because we made more profits than in 2021, or it could have been because we had more or less in terms of capital employed relative to the return that would actually have made. So that's basically how we interpret the return on capital employed. So depending on the information that you are given, the formula for calculating return on capital employed is basically operating profit over capital employed, but in most cases, it's reflected as profit before interest and tax over capital employed. So if you see the formula written this way, is one and the same thing, because profit before interest and tax is basically just your operating profit. So from a profitability perspective, at this level, these are the ratios that we are expected to know. So if you get a ratio analysis question in your exam, basically you know how to calculate the ratio and perhaps basically know how to interpret it. If it is increased, what could be the reason? If it decreased, what could be the reason as well? All right, then from profitability, the other set of ratios that we are required to know are basically your liquidity ratios. So liquidity is basically our ability to meet our short-term obligations as and when they fall due. If our creditors are going to come and say, can you give us our money now? Are we able to actually do that without actually going to borrow from someone else? So they are basically just two ratios from a liquidity perspective, your current ratio and your quick ratio. So your current ratio, you're basically saying your current assets over your current liabilities. So our expectation is you are going to go to your supplier, buy goods on credit, you sell them to your customers, perhaps also on credit, you are paid by your customers, and then you use the money you are paid by your customers to pay your suppliers. So our expectation is if you are buying something for $10, when you sell it, you are selling it for something more than what you would have bought it for. So let's say for argument's sake, you don't have any cash, you don't have any other current assets. You bought goods on credit for $10, and then you sold them to someone else on credit for $15. So it means our current ratio become 15/10. So our expectation is since you are selling goods at more than what you are buying them for, your current assets should always be more than your current liabilities. If your current liabilities are more than your current assets, it means you are facing liquidity challenges. Because if this guy is going to say, give me my $10, you are just going to take this 15, give him the $10, and you remain with 5. But if this was 15 and that was 10, it would mean that if he requests you to pay him back, you will not have enough money to actually do so. So our expectation is your current assets should always be more than your current liabilities. Now, there's something called a norm for current ratio and quick ratio. It's widely acceptable if your current assets are double your current liabilities, which means if you get $2 in terms of current assets, for every dollar in terms of current liabilities is considered to be safe. So if you are calculating your current ratio and you get 2:1, for every dollar of liabilities, you have $2 of current assets, it's considered to be safe. But anything less, for example, if you have got $1 of assets for every dollar of liabilities, is considered to be unsafe. Right? So that's your current ratio. But the understanding of current assets is you've got your cash, you've got your receivables, the people that you sold goods to on credit that can pay you at any time, and you also have got your stock, things that you bought from your suppliers that you have not yet sold. So that's what makes your current assets, and your current liabilities are usually just your payables or your creditors. So if you are getting 2:1, it means together with the inventory, bank, and cash, you have $2 of current assets for every $1 of current liabilities. But in reality, if a creditor is going to come today and say, can you please give me back my money? You can take money from the bank and pay. Or you could go to your own customers and say, can you give me the money that you owe me? I want to pay my credit. But the inventory is a different kind of current asset altogether, because these are goods that you have not actually been able to sell. So if your creditor is going to come and say, can you give me money now? You can't convert that inventory into cash immediately, because it may take time for you to actually be able to sell that stock. So for us to actually be able to measure the liquidity of a company, we need to exclude inventory, because the inventory are goods that we have not yet been able to sell. And then we consider the cash and the receivables, because receivables means it's that one obligation. So the customer that one obligation, then cash that Saka, it's as good as the total of the two is actually money we can quickly get for us to be able to pay our liabilities. So quick ratio is our current assets, but excluding inventory, which is not quick for us to be able to convert into cash. And then we divide by the current liabilities. Then we express it in terms of the number of times. So the acceptable norm is, if you have got $1 of current assets, for every $1 of current liabilities is considered to be safe. But the current assets here excludes your inventory. So a 1:1 quick ratio is considered to be safe. So let's look at a scenario and then see how we'll then be able to calculate this. All right, so let's say we have got this extract of the statement of financial position for the 2 years, 2021 and 2022. So these are our current assets and our current liabilities. So our current ratio then basically becomes, so our current ratio, we basically say for 2022, you're 40,000 over 160,000. And then for 2021, you 60,000 over your 30,000. Sorry, this is not correct. We're saying our current assets are 160,000, our current liabilities are 40,000. Okay, so it means in the first instance, for 2022, we are saying 160 divided by 40, we get 4:1, which means for every $1 of current liabilities, we've got $4 of current assets, which means we are in a safe position. We are able to pay our obligations as and when they fall due. Then for 2021, this is 2:1, which means for every $1 of current liabilities, we've got $2 of current assets. So this basically means we have actually improved from a liquidity perspective, because we now have more current assets for every $1 of current liabilities in 2022 than we had in 2021. So that's basically how we interpret it. Right, but then we need to then take consideration of the inventory that we talked about, because we said inventory is not easy for us to convert into cash. So if you want to see a proper position, we'd rather consider our current assets excluding inventory when we make this consideration. So it means for 2022, instead of taking 160,000, we are now taking 120,000. So we have basically just excluded the 40,000 for inventory there. Then in terms of 2021, we take 25,000. So it means here is 3:1. Then there, we actually do not have enough money to pay our liabilities if we are going to request today that you must pay us all of our money. So this is actually 0.83:1. So it means here we are in a good liquidity position, but in this case, we are not in a good liquidity position. If you are comparing the 2 years, it means our liquidity position is actually improved from a current ratio perspective, considering that it is we now have $3 per every dollar of current liabilities in 2022 than we have in 2021. So that's basically how we interpret the liquidity ratios. Right. So for our intents and purposes, these are the ratios that we are expected to know. So I'm going to share with you these slides, and also I'm going to prepare something for you in terms of class notes, so that you can then go through and learn in detail the ratios that we have calculated and everything we have learned so far. We are also required to know about limitations of ratios. We've calculated a few ratios, but relying on these ratios to make decisions might be limiting because of the number of issues. I'm going to give you, again, in the notes, a detailed breakdown of this. But basically, when you're calculating ratios, you are using historic information. But people who want to make decisions would rather make decisions based on things that are going to happen in future, as opposed to what has already happened, because things change. So its major limitation is based on information that is historic in nature. Then in revenue, cost of sales, they are related, but related party means perhaps there are two companies owned by the same person that are selling to each other, that could then sell to each other at prices that are relatively lower than if they were selling externally. So there could be issues with the related party transactions that can distort certain ratios or certain amounts. Then obviously, if a company is going to apply for a loan at the bank and the bank wants to use ratios, there's a possibility that the company can actually manipulate the accounts so that the accounts can send a certain message that the customer or the company knows the bank wants to see. Then seasonality means there are certain companies whose revenues come at a certain period in time that may not necessarily be the same as the year end. So looking at the receivables cash at year end might be misleading. Then we know that when you're calculating profit, there are policies that the company would have implemented in terms of depreciation and other estimates that may then distort the figures that we use to do the calculation. So those are some of the basic limitations that using ratios has. So that concludes our discussion on introduction to interpretation of financial statements. We are going to look at it in detail for those that are going to take the next module. For those that are not, that's as far as you are required to know at this level. So